Hey folks, welcome to another episode of Your World with Prakash Kapila. In this episode, we have an interesting topic that is going to affect not only you, me, but people across the world. Because past week, what we had was there have been two events that have captured the world. One was the speech by Joe Biden. The other one was the GameStop fiasco. And Congress, the U.S. Congress, has started to hear the different aspects of this particular huge financial turmoil for a particular company. Uh, just two companies. One is GameStop. The other one is Mervyn Capital. So this is a classic case of the financial system working in a way that can give a complete breakdown. A systemic breakdown can happen on a particular individual stock. So this is also a huge revelation for a lot of hedge funds and a lot of financial companies about the retail investor that is there in the market. What actually happened? So who are these players that created this huge thing? So that it went up to the highest power making body, which is the Congress of United States. And whatever ramifications, say new laws that happen, will be not only implemented in the US, but other countries will start looking at it. So this is going to affect all the financial markets is a very minute thing to say, because it is going to affect the way the hedge funds will work, way the market making is going to work, where the exchanges are going to happen, where the settlement is going to happen. So there are so many ingredients in this particular thing. So what is the basis moot point? Okay, let's come to the basics. So on January 24, 25, the stock price of GameStop was around $25, $20, around the range of 20. So in just 3 days, it went up to 400, an intraday high of 500, right? And then it stayed like that for like 3 days, right? So from $20 to 400 to 450 within span of a couple of days, it went just 22 $500 intraday, and maybe at the closing it fell to 350. So but still $20 to 350 over a span of a week maximum for a company. And there are so many players obviously that have made a lot of money, and so many players, and few players have lost a lot of money. The biggest loser here is Melvin Capital, which is a hedge fund. So we need to understand the holistic picture about the financial system to understand that this could happen to any stock, right? If the things are not changed, then this could happen to any stock, and we will see these kind of fluctuations happening across the board. Not a large cap, but at least a small. When I say large cap, it means a lot of capital and a lot of big companies that are there. They don't have much of effect, but small companies in terms of millions of dollars, and not to the extent of billions, but just a few millions of dollars, they are considered as small companies in terms of Nasdaq and and New York Stock Exchange, or any of the big exchanges, where billion-dollar companies and trillion-dollar companies trade. So for them, it's not a big issue, but for small cap stocks, small stocks that are in millions, having a lot, very less float. I'll come to these things as we as we proceed ahead, but just hang on with me. So some small stocks that are there are totally vulnerable with these kind of situations. This could happen to a lot of stocks. There's so 50 to 70% of the stocks are small caps. So imagine this thing getting repeated for all these small cap stocks over a specific interval of time. So many people will lose a lot of money. So many people will. So it's like, it's not about winning and losing. It's about market stability, right? So one stock like this happened. Maybe a few people have lost some money, few people made money. That's okay. But if this repeats for multiple such kind of stocks, that's when the problem comes. That's when we have a systemic problem. So before it can become a systemic problem, the eventuality of such things to happen should be reduced. So therefore, a lawmaker, a sincere lawmaker is one who tries to be ethical and creates laws in such a way that systems run ethically. So, being very ethical people, the leaders have thought that we want to investigate into this. We want to see if there is some wrong thing that has happened. Because if we don't correct the wrong things, then they keep happening, right? The scale will be very less, but over a period of time, it just balloons into a big thing, creating a financial instability into a lot of people's lives. We cannot forget the 2008 crisis, which actually put the whole world into a standstill, right? And so from then onwards, these lawmakers are very, closely monitoring, as they should, the different regulatory agencies and different monitoring agencies of this financial system. So cutting short the entire thing, let's jump into this particular stock. What is this stock? As you can see, it's called GameStop, right? So the GameStop stock went from $20 to 400 or intraday $500 in a span of very quick movement, and then came back to $40. In just a span of couple of weeks, it went from $20 to $500 and came back to $40. That has created so many millions and billions also. In this process, a company called Melvin Capital has lost $4 billion. $4 billion. I mean, $1 billion is like 10 zeros. Units, tens, 100,000, 100,000, million, 10 million, 100 million, 1,000 million is 1 billion. So nine zeros will make up the 8 to 9 zeros will make up 1 billion. So like that, $4 billion vanished from a company within span of 2 or 2 weeks, basically 2 3 weeks. So what? 2 weeks only, mostly one to 2 weeks. So what happened actually? So who are the players, and what is the big picture? So right now we saw the big picture that there must be a self-regulating mechanism so that these things don't repeat. Otherwise, what will happen? The same thing can be applied to other stocks also. So who are the players right now? What happened? Who are the players is what we'll go into, and then we'll go into detail, because this is a financial system. Lot of people in financial companies don't understand this financial system, how they work, how they operate, how they trade. All those things are not known to a lot of people. Okay. who are in finance. So forget about those people who are not in finance. So in this scenario, okay, there are set of people who are buying stocks, and there are set of people who are selling stocks. Okay, so in a set of people who are buying and selling stocks are called traders, right? In trading, right, buying and selling, there are long term and short term and medium term. Okay, the long term traders are called investors. Long term means anywhere from 1 year to 6 years. It's a very big time span. So for me, long term could be 1 year. For you, long term could be 5 years. So each of us have a different definition. So there is something called day traders. Who are these day traders? These day traders are those who buy and sell within a day. So not all people can. For a normal investor, there are three trades that you can buy and sell on a single day, within a span of 3 days, right? So this 3 days is a very important thing, right? So when you go to a bank and give a check, within 3 days, the money is available to you. That's called T plus three. The same thing happens for uh, taking a stock. So you buy a stock. By the time the stock actually is within your grasp, would in the from if you go to the exchange and buy a stock and the stock is given to you, it takes T plus three. That's called time plus 3 days. The exact time plus 3 days. So T plus three is when the actual thing is with you. This is the across the financial system. Okay, so when you send money to someone, when you put a check, when you try to do a financial transaction, all these things are T plus three. So the same case, who when you are buying stock, immediately the stock is in your account, but the person or the entity that is giving you stock is actually buying it from somewhere else. Okay, where is that buying and selling happening? There are multiple places where such buying and selling happens. So there is a big system. One is called the clearing system, clearing and settlement system. The other one is called the exchange. The other one is called market making. The other one is called channel makers, and the other one is called platform, trading platform. So what happens is when you do a buy of a stock or sell of a stock, it goes to your trading platform, TD Ameritrade, Robinhood, whatever, Charles Schwab. So those guys will in turn uh, give it to the people who already own that stock. Okay. So where does this happen? This can happen in exchanges, or this can happen in market channels. That's where the market makers are there. So the market makers are those who have lots of think about this as a uh, carry and forward where even I want to make it more simpler. Think about this as someone who is a player in the market, and they have some stocks with them. So someone is asking to buy. Someone is asking, saying that, okay, I want 10 GME stocks. I have millions of GME stocks are there with me. I am the market maker. I have someone comes and says, I want to buy 10 stocks. Okay, so 10 stocks I will give it to that person on the price that is benefit to me. Okay, so like that, instead of going to the exchanges, the platform comes to me asking for the stocks. So I am the market maker or a channel partner for that particular trading platform. Okay, so for Robinhood also, Robinhood was the player, trading platform here, which had been a big part in this GME trading this thing. So what happened is the trading platform came to me. Who am I? I am the Citadel Partners, Citadel Securities. So the Citadel Securities guy had lot of stock of GME, and Robinhood asked the Citadel to sell him the stock, so that the or sell the his retailer the stock. So his customer, that is some retail trader, getting the a retail person getting that stock. So what happened? There have been so many people who are in Robinhood. Okay, Robinhood is a trading platform. There are so many small guys who started trading on the GME stock. So before that, what happened? How did they start trading? Why did they start trading on one particular stock hugely? So here comes the other part of the story, that is called a hedge fund. Okay, there is a Melvin Capital, which is a hedge fund. What is a hedge fund? Hedge fund is basically telling you that if you are a rich guy, or some Bill Gates is there, or some rich guy who has a lot of money, and instead of putting that in a bank which doesn't pay much of the interest, they use the hedge funds. They also invest themselves. They use hedge funds, they use venture capital, they invest on themselves. But to be on the safe side, what they do is they give money to hedge funds because the returns are more. So some smart guy is there, right? So that guy has knows the market, does a lot of research and all those things. So what does the investor do? He gives it to that smart guy. Hey, you make money and give me money. So they have this thing called 2 and 20%, where they take 20% of the profit that they get. So some chunk of the profit the hedge funds will take, and the remaining 80% is kept by the rich guys. So if I have say $1 million or $100 million, right? So then what I can do, there is a cap, right? If I'm just $100, I can't go to the hedge fund. There is a cap, like 10 million, 15 million, 25 million, like that. So based on the risk profile and risk portfolio the hedge fund guy maintains, there are rules and regulations on where the hedge fund guy can accept the money. Okay, because it's a hard earned money, and it's not something like, okay, someone has put some um good words and fooled some guy and took money. No, it's not like that. There is a particular set of rules that make a company a hedge fund. So only a person who has net worth of say 15 to 100 million can go to a particular hedge fund. Someone who has more than 100 million to another 200 million, they can go to another hedge fund. So the mutual funds that are there, that need to, like retirement systems, teachers retirement systems, like CalPERS, teachers insurance, all those guys that need to pay the employees a certain amount of money after they retire. So those kind of systems, they have huge billions and billions of dollars that they need to pay. So what they do is they take this thing and put it into these different companies, and ask them to invest on their behalf. So this is what hedge fund does. They take the money from a very rich guy or entities, and they start investing in a different things. Each hedge fund has got its own strategy. So there is one strategy called long short. Okay, what is this long short? Long means buy, short means sell. Okay, so equity long short means a hedge fund is buying the stocks or selling the stocks or shorting the stocks. Okay, selling is different and shorting is different. Selling means whatever you own, you are giving it. Okay, you're trading it. Shorting means what you don't own. You don't own the stock, but you say, I want to sell so much because the stock is going to come down. Say, Microsoft is there, which is going at, or Morgan Stanley is there, which is going at $75, right? So you understand that, okay, the market is not great. So there could be a lot of turmoil in the street. So therefore, they won't get their loans back. So what you think? Okay, today it is 75, but they won't get the loans paid. They will face a lot of problems. So the 75 should come down to 60 or 50 or 40, whatever, right? So then you say, okay, I'll sell it at 75 and I'll buy at 50 or 45. So what you do is you sell the short of Morgan Stanley, right? Or Morgan Stanley, whatever stock. So Morgan Stanley, you sell short, and then what you do is you wait for the time. So that's what the shorts do. They have a theory in which they understand the market, they understand the principles of the market, and they see that the present price of the stock is not in proportionally to the market. So what they say, okay, the market is saying the stock is this level, but the stock is actually at this level. So what they do is they say, okay, I'll sell it at this level. So they do a short. So when the price comes down to this level, then they buy this. So the difference of the money is what the short guy gets it. So what Melvin Capital has done is he has taken GameStop, right? GameStop was already at $20. So why did they do short? So what the GameStop, what the Melvin Capital said is this $20 thing is going to go to zero or whatever, 4 5 whatever. So from $20, the actual market rate of GameStop is at really zero level or some level. So what they did is they shorted this $20 stock for 2 years. So from $40 it came to $20. They have been shorting it for like a couple of years. So the point is, around every quarter, what you need to do is, whoever is a big hedge fund or financial company, what they need to do is they need to submit reports to Securities Exchange Commission. Okay, so they have to give money to that. They have to give the reports. They are called 8K reports, 8K, 12K reports, 13F, 8K, 12K. These are all different kinds of reports that SEC takes from the people and puts it in its own website. It's a public information. Okay, so the uh, hedge fund that has been shorting this GameStop from $40 to $20 has submitted to the SEC saying that I have shorted this stock for a couple of years. So here comes the big problem. They have been shorting from 40 to 20. Okay, and others have also started believing this, and they also started shorting. So over a period of time, there have been, if there are only 100 shares, 140 shares have been sold as a short. How is that happening? There are only 100 shares. How can you sell 140? And who is that the other buyer who is buying that non-existing 140? That was the biggest question. So here comes the market maker. So what did market maker do is, there is something called dark pool. What is this dark pool? Say there are 4 to 5 big companies. They say, okay, we all own a huge amount of GME stocks. Say millions and millions of GME stocks we own. So what we will do is, to maintain the market stability, we will create dark pools. What is the dark pool? Who is buying and who is selling is not known. So this is not known in the exchanges. So there is a dark pool that a lot of people say, these are all the institutions that are holding the stock. So the guy who is coming in takes that stock and goes. Okay, so the guy who wants to give stock, so comes in and gives some stock, but the guys who are selling the stock or buying the stock don't know who are the sellers and who are the buyers. See, if you go to some farm market, for example, there will be buyers, there will be sellers. Okay, the seller knows the buyer. Okay, but in dark pools, the seller are and the buyers are different people. The buyer is not buying it from the seller. The seller is not selling it to the buyer. The seller is selling it to some guy. The buyer is buying it from the some guy, some other guy. So just like your if you even in farm, right, the farmer doesn't sell to you directly. The farmer sells to the store, and the store sells to you. So think about it like a store where farmers don't have interaction with the customers or the people who use the vegetables, right? So the trader buys it from the farmer and sells it to the retailer, like consumer, like you and me. So that is called the dark pool. So what happened is, so each of the persons started selling the stock short, but there were only so little. So there was a downfall. There was a deficit of 40% of the stock that had to be bought, whatever may be the case. So then started the whole thing. So this information, someone identified that this was the information. So who identified it? There are a few people like Keith Gill and others. They identified that this stock has been shorted for far too long. So there is a short as there is a bull long, right? So the short guy thinks that the market is this stock price should come down because according to his theory, this is the price. This is the actual price. What does a long guy think? This is the price of the stock, but the market, this is the price of the stock as per the market. But in future, because of whatever reasons, like they are coming up with new products, new revenue, the market should actually raise. The price of the stock should raise. So that's called long. So the long guy started thinking that the price of the stock should raise. The short guy is thinking like this. Short guy is thinking the price should fall. The long guy is thinking the price should raise. Now comes the picture. So the retail traders have understood that, okay, there is some deficit of stock. So if we start buying this stock, then they have to fulfill that. So they have to keep on buying. So when they have to keep on buying, when the stock is not there, you have to buy. So what you do, you increase the price so that the small person who thinks that, okay, I have the stock, I can sell because I think it's a very good. That's where the market makers come into picture, who say, okay, let us give some price, let us name some price so that he can buy it or sell it. So I have lot of stocks with me. I start to pump the stocks up according to the market. So these market makers, what did they do? They took the orders from the Robin Hood, and they took the orders from the Melvin Capital. Okay, traders from Robin Hood wanted to buy, and traders from Melvin Capital wanted to sell. After a certain time, these sellers had to become buyers because there is a deficit of stock. So what did they do? Everybody started buying. The sellers are not there, only the buyers are there. Now who is the guy who is going to determine the price? Market maker. So they said, okay, this many stocks are coming in, so let me buy more, let me buy more, let me buy more. And once the seller who has come and said, hey, I don't have anything to sell, so let me buy something so that I can sell it. So when the seller had to buy, that's when we call it as short squeeze. The short squeeze happens because the seller has to deliver the good because he has already sold it. Now he has to buy. He needs to say. So think about it like this: you went to a market and say, hey, I have 1 ton of tomatoes, and you took the money of tomatoes for say $10 or say 10 rupees or 5 rupees or whatever at 10. So then you go to the farmer. The farmer says, I am going to give it for 15. What will you do? You have to give already, you have already promised 10, you have already taken the money. So even if it is 15, you have to buy, right? So that's how the stock prices started increasing. But this is not uncommon. This is very common. What actually happened here was the prices of the stock started increasing like tremendously. So there were only buyers, there were no sellers. So when there is only a buyer, then it becomes, then whoever has got a lot of stock, they will do market making. They will say, hey, the 20 is now 30. I have 1 million, right? So the first 10 I will sell for 30. The next 10 I'll sell for 50. The next 10 I'll sell for 80. So like that, they started selling it because the market is ready. Market is ready to take up anything that the stock is offered at. So the 20 became 40, 40 became 60, 60 became 80. So once 20 became 40, what is the percentage? 100%. Once 40 became 60, what is the percentage? 50. So very quickly it started increasing 100%, 50%, 200%, 300%, 3000%. 30 times it just stumped like anything. So 20 into 30 is 600. So around 2500% it went. 25 into 20 is how much? 500, right? So like that, a stock price bounced 25 times or 20, 23 to 25 times within short span because there were only buyers and there were no sellers. So then comes the DTCC saying that, okay, now you are starting to buy so much. So show me that you have money. To whom? To Robinhood. Why? Because the retailers are keeping on buying money, keeping on buying the GME stock. So this guy had to give them the stock that there is there, but this guy had to go to the Melvin Capital. The Melvin Capital at one point, this has go to Citadel Capital. The Citadel Capital has to tell to the DTCC that I am selling so and so to this guy. Now the DTCC has said, do you really have that much money? Show us that much money that you can buy so much of things. So that's when at morning 5 o'clock, the Robinhood CEO got the call saying that, okay, I have to show some money. And then he started calling the investors to pump in more money into his account so that they can show it. Remember, the retailer, the trader like you and me who are retailers, we don't go to the exchange directly. We go to our trading platform. The trading platform is one that delivers the stock to us. We don't care about the market makers, hedge funds, DTCC, exchange, NYC, ARCA, BOT. We don't care. You, they're all covered up. The first entry that's there is Robinhood, the trading platform. That's where we interact. So this guy is having lot of this guy is getting lot of demand for buying the particular stock, and the exchange is saying, hey, show me that you are starting to buy so much. Show that you have enough money to actually pay the other guy who is giving you the stock. That is called liquidity. So the liquidity issue happens when you start buying and you don't have money, right? So that's what the DTCC says. Okay, you have to show that you can have the sufficient amount of money. So what did Robinhood do? He said, okay, I am not going to buy anymore and I will only sell. So all these guys who wanted to buy couldn't buy. Okay, so they had to wait, or they had to or think that, okay, let's sell little bit so that we'll cover our basis, we'll be able to make some profit. So those guys, and then comes Melvin Capital. So Melvin Capital also should buy. It has so much of it has sold so many things, so it has also to buy, but the price is so high. So when Robinhood is not able to sell to the not able to give the traders these stocks, where did this Melvin Capital buy it? Maybe from other trading platforms, or maybe from the channel partner, which is the market maker. So what market maker did is he infused money into. So the Melvin Capital said, "I don't have money. I want money." So Melvin Capital went to the investor, his own investors, for asking more money. And Robin Hood also came to the investor asking for more money. So what did the Citadel Capital do? It gave money to both of them for a particular interest. That's what they do. I mean, that's their business. They give money, they give stock, they make all these deals. So this is a exact financial crisis on a one particular stock, wherein there was a squeeze of short squeeze happened, and overselling of the stocks happened, and lot of people understood that short squeeze would happen, and they started um, buying it, so that if I know the price of a particular product is going to go up, I am going to buy it now with whatever I can. I'll take whatever money and I'll put it there so that it goes up. So like that, they started buying, and each individual started buying, and they became a so huge force that even corporates that are like $12 billion worth of company couldn't withstand that force. Thousands and thousands started pouring, with millions and millions of people poured thousands of dollars. Then it became $1 billion fiasco. So lots of billions started to come in to the market, and lot of billions started getting distributed across, and this created the zoom of the stock. So who benefited out of this? The retail traders of Robinhood. Most of them benefited till it went up. So what is the other thing that has happened? Not only did retail investors invest, there was also market maker who invested, who has already invested in that, who made lot of money with that. Okay, he got the middle maker, market maker got money hugely by buying, by giving the stock to the buyers, and by accepting the stock from the sellers, right? So for 2 years he started accepting the stocks, and in 2 weeks he started selling the stocks in such a way that he has bought it at $20 and he has sold it at $500. $20 stock has been sold at $400 to $450 and even $500 in a span of 3 days, 3 4 days. So how much stock has been sold, how much has been obtained? If we take a look, Melvin Capital's $12 billion worth of company became $8 billion worth of company, and the Citadel Capital had to invest $4 billion in them, and Robinhood had to stop the traders from buying. So once the buying stopped, the amount of buying, when it stopped, the stock started selling. So the Citadel Capital, which had to give the stock to their customers, had to uh, buy that stock, and when it is falling, they were able to recoup they were not totally out of the industry. They were able to survive with $4 billion loss, and lot of people who started investing around 250, around 300, they got hampered. Those guys who were investing around 25, 30, 40, 50, 60, even $70, $80, $100, they were okay, but it zoomed to 430. So when the zoom happened, whoever has bought around $400, they got smashed. Smashed in 2 days, 400 to 40. In 2 days, 400 to 40, the stock fell. So when someone buys a stock, they think that, okay, today it is like this. In 2 days, it has gone. In 3 days, it has gone to 500. It won't fall to 50. So let us wait even if it is falling. So what is the retail investor going to do? Hey, it's falling, it's falling. Maybe it will increase, maybe it will increase. So the fall will also not be like it is mind blowing right now. So usually the fall should be like, it falls, it raises, it falls, it raises, like that it happens. But in GameStop, the fall was like very rapid, zoom zoom. Within very very short time, the $400 stock became $40 stock. Very short time. So a lot of people who have invested within a couple of days and not sold it, they lost. If you were an investor, you lost. If you're an investor at 50 or 100, you lost. If you're an investor right from say 100 to 400 or 500, all those guys who have invested from 100 onwards, all of them lost. So there is a huge loss to lot of retail players, and there is a huge loss to the hedge fund, Melvin Capital, and there is a huge gain for the market maker, Citadel Capital. The scope of the investigation we never know, but it is ongoing. Whatever rules or law that US will come up with, European Union, India, China, they will, Europe, UK, UK is after Brexit, it's different. So Australia. So once two or three exchanges accept, then all exchanges will accept, because this could lead to a systemic failure. If they start hunting out these stocks like this, then the money will start running away from people who are retail investors. Okay, folks. Hope you have learned something along, and look forward for you in next week. We will talk about Biden's diplomacy and foreign policy. Thank you. You have a wonderful day. Bye.